let's look at, we always start off by looking at the S&P 500. If we look at our chart, and this is our trend line here, this blue line, you can see the times to buy the stock market in general is whenever the stock market or the stock is near oversold and near the bottom of the channel. That only works if you're in a situation where you have a momentum in the stock and it's going up. So right now we're actually way at the top of a channel and we're overbought. And we've been that way for quite a while. But it would be very normal for us to go in a straight line down to here, which is about 5% below where we're at right now. So don't be surprised if we have a correction, but I've been saying that for a month now, so it hasn't happened. What we have right now is momentum in the stock market. In the last week, we went from 66% above the 200-day to 73 for 50-day, and we have 73% to 76% of stocks in the S&P above the 200-day moving average. That's like a definition of momentum, and everyone's excited. This is a time, in general, when you see those signs, those are the signs where, well, keep holding what you're holding. If you have to get rid of something and you don't like it, now's the time to do it, because we're overbought and everyone's super excited. We just need one little piece of bad news and we're down here. Okay, so if we look at our calendar, we're overbought now. I didn't update this accurately, but this should be yellow. We're probably going to be going down for a while because we're overbought right now. So we have a couple things. We had the Fed speak on 2 days ago. So Jerome Powell said he is on a track to lower interest rates. He has said a couple other things. Another thing about the news that happened recently is we had a good jobs report today. So that means the economy is strong and we're probably not going to go into recession. But the problem with that is they'll raise or keep interest rates higher for longer if they have a strong economy. All right, so we have a Fed meeting in the middle of the month here, so 2 weeks. So a lot of volatility is going to be around whenever they decide what to do with the next interest rates. The other things that are happening, we have the earnings starting again in April. So it isn't until then that we have some kind of catalyst for a lot of stocks to go up and down. And if we look throughout the whole month, let's look at the month. These are usually good months. March, April, May are some of the best months. Probably because we do have the earnings coming out in April. So that usually kickstarts stocks. So right now we just don't have a whole lot of news coming out. There's not only economic news. There's no more earnings reports, at least for another month. So that's why it's kind of it's going to be in the doldrums for like a week or two now. Anyways, the reason why we're going over these, market, this is called market timing, when you're trying to time when the market goes up and down. And you do that because if you have money to invest, you want to invest it when everyone's selling and the stock market's oversold, not when everyone else is buying, like right now, and it's overbought. All right, so let's look at some of our meeting notes here. Our concentration on this year is reversion to the mean. Healthcare, telecom, financials, and biotech. These are all sectors we concentrated on at the beginning of the year that did not perform well last year, that people are actually turning to now, and they're actually becoming outperformers. If we look at some of those sectors now in our ETFs, let's look at those. XLV. You can see this is the healthcare ETF. You can see it's breaking out to an uptrend, and all the stocks in the healthcare world are going up with it. Let's look at other ones here. XLF. This is the financial. Last year they were out of favor because the bank was going. 2 banks went under this time last year. And so there was a lack of confidence in that sector. Now you can see that sector is breaking out. So these are becoming leaders. Energy is not becoming a leader, or energy is not. It's kind of going sideways. And real estate isn't either. So okay, so let's continue with our worst to first checkup. We already talked about the S&P. We have a small little uptrend happening here with the S&P. I don't know if we break out of that, we might go into a higher this channel, but chances are we're going to be stuck in this zigzag pattern here, zigzag going up. And okay, I'm keeping track of the 10-year Treasury. It's been going down this week, and that helps the stock market go up. So as the Treasury goes down, it's an inverse correlation recently. You can see the 2 years inverse correlation too to the S&P 500. That's because if the Treasury goes higher, that means there's competition to stocks. If you had a 10% yielding Treasury, no one's going to put money in a stock that yields 2% and grows at 1%, because you can get a better yield with a guaranteed investment. So let's look at some of the variables in the stock market. Oil is it's around the same as it was last week. This is kind of, we don't really know what the reasons why oil prices go up. It's supply and demand, but we know if the price of oil is lower, then the economy and people demanding gas are less. So the economy is bad if the price of oil is down. But if the price of oil goes up like to 100, that means the economy is really hot. Indication. And there's other things. If countries or companies don't output oil, then the price of oil goes up. And so, but this is the biggest cost. One of the biggest costs for most businesses is transportation, cost of oil. Again, other variables are pretty much the same as last week, so we don't have to concentrate on that. Fear and greed index. We're still greed, extreme greed. So we're still around there. Let's look at the stock market today. See what's going on. Yahoo Finance. Okay. Okay. So we had a strong job report, and that shows us that we're not going to go into a recession, and rates will stay higher longer, and that's bad for stocks. Okay. Here's a story about NVIDIA. It looks like primed for a stock split. As soon as it hits $1,000 a share, it might split. And that doesn't affect the value of the stock, because it's like 1 gallon or 4 quarts. You can have, doesn't matter how many shares you have, it's what the value of each share is. Let's see. What else is happening here? Oh, okay. TikTok faces possible U.S. ban. Okay, so there's some legislation in I think the House to ban TikTok, and that would be good for Google and Facebook, because that is a major competitor to those two platforms. So let's watch and see if that happens. Because the reason it'll be good for both of them is anyone who used to use TikTok will want a short video service, and that'll get more users to Google and Facebook. So what else do we have here? Okay, we have this New York Community Bank Corp had a buyout earlier this week. We've been watching it go down 30% last couple sessions ago. This company got over its skis when it bought a bank last year that was going to go under. And there's some smart people that invested in it, so it looks like it's not going to go under, but we're not smart enough to understand regional banks. And a lot of times people smart people like Mnuchin invest in this company, but they could very easily go out of business or have to be taken over in a year. We don't know, and it's like a gamble. So we stay away from that. Okay, let's look at some of the market movers today. Okay, so the ones going up the most are, these are like utility companies, like Energy, Evergy. So that's like a conservative thing. So people are going out of the, they're moving out of risk on into something more conservative today. We have some banks. These are all conservatives, paid dividends, except for Cardinal. Okay, the ones declining the most, Costco. You see, Matthew, what can you tell us about Costco going down? I didn't follow the report.
So it seems that, I think profit and stuff was up, but sales was down. So they weren't, I guess, doing as much volume as they planned on. So it seems like in general it was pretty good, but that I guess that lower. So I don't know if they lowered guidance then on sales, but I didn't read the full article yet.
Oh, okay. So that's an example of a stock that's priced for perfection. Let's look at. We've been saying for a while it's a very reliable stock because, 90% of their revenue comes from their membership fees. Or I don't know what the percentage is. Is it? And
that's about right. Yeah.
Okay. So that, and people renew it over.
Yeah. Profit.
Yeah.
Comes from that, yeah.
Profit comes in, and their renewals are almost 100%, like 90-some%. So that's very steady, predictable business. The problem is we've been following this for a while, but their PE is 50, but they're growing far less than that. So they're growing at 10% a year, a consistent 10%. So their real value is 5 times, if you divide this by 5, because the PEG ratio is 5. So the fair value is something like 125 or something. But at any little hiccup with their earnings or some kind of accounting irregularity, it'll drop, an amount like that. But let me see. So let's look at their other numbers. Profit margin, it's razor thin. So they don't make a whole lot of money on what they sell. Let's say they sell hot dogs, for $1. They cost them 99 cents to make it. That's an example of a profit margin. But the return on equity is really good. Matthew, could you tell us more about this? You're like an expert in this. What have you seen as good reasons to buy this?
I think it's the consistent membership fees, drive profit, and I feel like it's a hard number to get. I've been trying to find this. I haven't found new information for quite a few years on what percentage of U.S. households are members, but I think it's a pretty high number. So I actually think their growth in the U.S. is going to be limited, just that they're kind of saturated. But it does seem like the last time I looked at this last quarter was their international growth was doing quite well. And so they are expanding. I think, they have quite a few in Canada, but they're also been expanding in Asia and Europe a bit. And it seems like that plan was working well last I checked on it. That's one of my biggest concerns is if they can't replicate their experience outside the U.S., I think that would be, kind of bad for the company long term. I think they'd be pretty growth limited.
Yeah. Well, one good thing that Mark brought up is one of the biggest cheerleaders for the stock was Charlie Munger. And if you have like Warren Buffett, he's associated with Apple because that's his biggest, stock position. But Mark was saying that Charlie Munger was on their board, and he advised them. And I think that's a really good indicator that it's a decent stock to buy and hold. And
I think one of the other advantages, I think even fairly affluent households are members, right? So I think the idea also is that kind of during like downturns and recession, I don't know that Costco will have the same sort of drop that like the other kind of higher end household retail establishments would have.
Mm-hmm. Right. Well,
I think I read somewhere that most of their money comes from membership, and since they're always relying on people to renew their membership, that's where all their money's coming from.
right.
And I think they're due for a membership increase this year. Fee
Okay.
increase.
Yeah, if you have a membership increase, and also they also pay special dividends too. That's, for instance, like once a year, they'll have some extra cash and they'll return it to a one-time dividend to their shareholders. So they do that like once every couple of years. So that's kind of a nice thing about being an owner of this. I just divided the years, by, and I found that they're already growing at 9 or 10%. So if they're growing at 9 or 10%, and let's look at they're growing at 9 or 10%, their PE is 50. That's 5 times. That's where they get the PEG ratio of 5. So you're paying, when you buy this stock, you're paying for this very steady growth. See how that's very consistent over time. And it has to like go perfectly, they have to meet their numbers or else they'll take a hit. And that's kind of what happened. I guess if you're buying it and holding, maybe after 5 years, if you bought it today, in 5 years, it would be fairly valued. Something like that.
Yeah. So one of the things I think that I think their reputation is very valuable. If they lost their reputation, I think, for example, a lot of people who are members, they only carry like one of something, right? They only carry like one air fryer. They only carry one bicycle. They only carry, and people rely on that to do the shopping for them. The buyers at Costco, I think, really do a lot of product filtering for people.
Mm-hmm.
And so it's like, I want a robot vacuum. Well, I'm just going to buy the one that Costco has rather than spending, a couple hours trying to figure out which robot vacuum do I want.
Oh, okay.
And so if they lost that, I think that would be a real hit to the business. But yeah, no, I agree that they are priced. They're expensive. They've always been expensive on the stock side. But and a lot of that, I think, is because probably people who are members also are owners, stockholders.
Mm-hmm.
I know that it used to be that a lot of like kind of the Wall Street trading firms didn't like Costco because of the they don't feel like it was getting as much profit as it could out of the members, but then I think a lot of retail holders own it.
Yeah, they could raise their prices. I mean, their margins are razor thin. And that means if you look at this profit margin, they don't make a whole lot for every one of the things they sell. So that's, if they raise their prices just across the board just a little bit, that could get this profit margin up,
But then they might lose the membership.
Yeah, that's a trick.
The issue here is Walmart is right after that tells. Walmart with a new membership package is rivaling with Costco. It even allow delivery at home, whereas Costco rarely deliver.
Oh.
Costco only deliver on big merchant items, but not on the daily products.
They do. You can buy like pants and shirts and stuff online, and it'll do delivery.
Yes, but if you try to buy some meat or something, it's a bag of or sack of rice, they're not delivering.
Yeah, their online thing is a very different thing than they're not. Their online, I think, products are kind of very separate from the store. It's a very different kind of supply chain.
Yeah, I think you're right because their online stores actually have different prices than the stores, and they said that they are not affiliated with each other.
Yeah, the online prices are quite different. They include delivery, and it makes the costs higher. They also do a bunch of like business delivery. They have like these business centers, and will do commercial deliveries too from the local store somehow. But that's a different thing than the main stores.
They just expanding the business sector. It's called Costco Business Center or something. If you got a regular Costco membership, you can go to the business center. I heard that they have more discount on the business center side.
Well, they do bigger things, like things that you don't, they'll have commercial size things that even like the regular Costco member would be too much for. So.
Yeah, you can get a side of goat at the business center on St. Charles Rock Road.
Yeah, I think it's more for like restaurants and stuff or hotels and stuff. So they basically like, they still sell like chips, let's say Doritos, right? You're used to getting Doritos at the warehouse and you buy 20 packs at a time, when you go to the regular warehouse, but then when you go to the business center, they sell you 40. And I think the prices are only different, only when things get close to expiration, they drop all the prices down and people run and get them then. But I really think that their prices are very similar from both places.
So one weapon that Costco has over Walmart is it actually have a lot of in-house products. Right? That's how it able to keep the price down, and I don't think they will change that anytime soon because, like you said, it erodes the advantage they have. So, but Redland is one of their in-house main producers and make a lot of products. Keep the price down.
All right. Well, we're gonna look at the S&P just to see what is going on today. This move we've had here is pretty unprecedented. It wasn't until the last time something like this happened was like 1964. So every time we meet for the past since November. So that's like 2 or 3 months. I've been saying, oh, we're overbought. We're overbought. We're overbought. It's not the time to buy. It's overbought. And it keeps going up. And whenever that happens, trees don't grow to the sky. Eventually we're going to have it go down like this again, You just have to be ready for that. A lot of times you look at these moving averages to determine what levels of support there are if we do have a correction, if it's going down. For instance, right here, this is the 200-day moving average, the green one. This is the 100-day moving average. And this is the 50-day. This is the 20-day. So you can see that whenever stocks fall, a lot of time, or the stock market falls, they kind of hit a circuit breaker right around the moving average because there's a lot of algorithms, a lot of people that watch that. And as soon as it hits a moving average, then there's a little bit of support. And we'll go over a couple more charts to show you some more moving averages. Let's look at Google. There. Okay. So you can see that this is a 200-day moving average. This is one of the most powerful moving averages to follow because in an uptrending stock, whenever this moving average is going up, it's basically a moving average is a sign of momentum, that there are more buyers than sellers for the past 200 days. That gives like the upward slope of that. And a lot of times whenever it's still going up, there's support there if there's like a chart like this. And Google actually went down to that moving average earlier this week. And you can see it's totally oversold too. And whenever I drew my lines for Google Alphabet, okay, you can see that the bottom of the line, this doesn't happen very often. It's, whenever everything matches up where the stochastics are low, that means people are oversold. That means the stock is oversold, and we're at the bottom of this channel. And whenever something like this happens, we either bounce and go up to here again, or we break out of this. And it seems like Google's bouncing here. And so that was a good little exercise. But that's why you follow those moving averages. Let's look at some more things here. We're more bullish every week in this survey. So bearish, it's time to hold your nose and buy. And whenever they're bullish, it's time to take some profits. All right. The US dollar is down 2% this week. It's in a sideways pattern, so it's not really particularly impactful for stocks right now. But if the dollar goes down, that helps international stocks a lot, like the big 7 tech stocks. VIX is unchanged, so people are pretty complacent. They're not buying protection, and they're super excited, and they're greedy. Everyone's excited about the AI craze until that pops. So the things that we have to worry about for the stock market crashing, we had a commercial real estate problem with this New York Community Bank this week. If we have banks going under, that is a loss of confidence, and people will start selling off the stock market. So let's hope that doesn't happen. We still have the Magnificent 7 stocks that keep on going up, and if they correct, the whole stock market will go down with them. And let's see if the AI, every day the AI stocks are going up, like exponentially. So that won't happen forever. As soon as that bursts, the stock market could go down with it. That all it could need is just maybe one bad report from one of the leaders. And one thing I'm still worried about is the Treasury, the amount of debt that the United States has. I've heard a story that this week the debt of the United States increases $1 trillion every 100 days in interest payments. That is pretty scary. So we might be in a position, maybe 10 years from now, I don't know, but we have hyperinflation in America. So if we keep borrowing money, it's going to cost more to get China to buy our debt. And that means the cost of a banana will be $10 a pound. So let's hope that doesn't happen. But right now we're on that path. And I don't know, I'm thinking, well, investing in gold or something like that for a portion of your money might be good for that problem. But right now it's not going to be cataclysmic, but in the future it will at some point in time if we keep doing what we're doing. Okay, let's look at the first to worst. We're seeing a lot of the sectors that were worst last year. The healthcare, consumer staples, utilities, they're starting to pick up and be outperformers. Financials are doing good, industrials. And right now the IT could be coming out of favor. They're one of the best sectors so far this year, but they're super overbought, and looks like the ones going up today are the more conservative stocks that are in this list. So let's see if we do have that change going on as a theme this year. We're still following the AI revolution and weight loss drugs as 2 catalysts for the stock market, because a lot of companies are affected, good and bad, with weight loss drugs.
I'm
Right.
just curious,
Yes.
any of the AI company actually make money?
Well, we know NVIDIA is the biggest beneficiary.
And NVIDIA is just provide equipment for AI company, right? So they're not in AI business.
Yeah, I think the AMD is actually doing a lot. A lot of the Microsoft is actually monetizing AI with their add-on to Office. What is it called? Copilot. So they're actually one of the first companies to actually monetize that with the actual product that's useful, and we'll see in the next quarter if that actually helps their revenues. But a lot of this could be hype too. I mean, you can be claiming yourself to be a AI company and then nothing comes about it. So I think that's more than half of the companies that are going up that are AI related. There are companies that put AI in their name and it goes up. They don't even have to prove an if-then statement can be an AI. No one can prove that.
My point is, if they not quantify their revenue that depend on AI, then they wouldn't lose anything because they never actually plan making any money from AI to begin with.
Yeah, well, there's I'd say over half of the companies that claim that AI companies aren't.
Right, but
that's like
they say that add to their bottom line revenue, that's a different story.
Right. Well, we'll see. We'll be seeing that. That's like Warren Buffett said. We'll see who's swimming naked after the tide goes out. We'll see if actually these people are going to put some products behind their AI and make some money or not. It's a lot like the .com. You put a .com in the name of your company in the year 2000, and your stock went to the moon. So it's very, very similar. Okay, so let's see. All right, let's look at the sectors going on that are going up and down today. You have the market movers. We saw that. These are all the AI companies. They're starting their bubble is starting to burst now. You can see all the ones that have been like going up lots. Our AI theme and our weight loss drug are both kind of imploding today. Eli Lilly had a setback on their Alzheimer's drug today, so that's why they're down 3%. But we see these are all conservative stocks today. So we're going from risk on, everyone's bullish, to everyone's starting to get conservative today. Let's do the sector ETFs. And first of all, let's look at the 10-year. The 10-year Treasury rate. That tells us a lot about what the sectors will go up and down. So if the interest rates go down, that's good for banks, that's good for real estate, it's good for anyone needs to borrow money. That's like people in debt, like companies in debt. Let's see if that comes out. I think what's happening here is the AI bubble is starting to deflate just a little bit, and you have the technology going with that. Let's look at the price of oil. Oil is down 1%, so that means all oil stocks go down. Okay, and home builders. No, we expected home builders to go up because if interest rates go down today, it's not that easy, but that's the correlation that's been working. Let's look at the stocks that are going up today. We have real estate. Okay, that makes sense. If interest rates go down, mortgages are more affordable, and that's why you have real estate going up. Telecom, utilities, these are all very conservative sectors. So we might be, what might be happening today, this could be like an inflection point. I'm not trying to make an inflection. I'm not trying to guess where the stock market's going. But as soon as, we start going down, the tech stocks, high risk beta stocks go down if we're in a downtrend here. And ones that do the best are the conservative ones, which like the utilities, all the sectors that are going up today. So we have a little turn today. See how long that lasts. So we do see healthcare as one of our healthcare. It's a conservative sector. It's going up too. All right. So let's look at what else we can look at. Let's look at the set of talking points. All right. So I pulled out some charts that were interesting. You can see we're hitting this. It's a wall. We can't break out of this into a new uptrend. We're just kind of stuck here, and that's why today we're not going up out of this. It seems. Let's look at some more things. Stochastics. Okay, let's look at Dan Now's picks. At the beginning of this year, we saw, all the stocks he recommended as being the best picks for this year. Amazon up 16%. Meta is up 44%. Meta has another tailwind. If TikTok is banned, that adds to their tailwinds. XBI is up 10%. That's the biotech ETF, so healthcare again. So Dan turned out to be like really good with his top picks. Let's see. Okay, here's some charts that I pulled out. We already talked about Apple. Alphabet. We already talked about Alphabet. You can see that Alphabet was in an uptrend for a long time, at least a year or more. and it recently broke through this channel, and that's an indication that it might go down more and start a channel going this way, maybe, I don't know. But it held at its 200-day moving average, like I said, and it looks like it's going to bounce and go back up here. But if it breaks down to here or here, it'll just sell for a lower valuation than it is now, but it's still a quality stock. Let's look at Novo Nordisk. This is one of the stocks in the news. They have a drug for diabetes, I think. Is it diabetes? And a kidney drug for weight loss drug. But they're repurposing this drug for other reasons, and they went up 8% this week. Where is it? Hold on. There it is. So they're in a new uptrend. This Novo Nordisk. They're battling Eli Lilly with weight loss drug products. Another one here. This is Apple. It's very interesting that Apple was in an uptrend, but you can see it broke out of that uptrend, and it seems like it's going sideways now. So let's watch that. If it breaks out of here, then it's oversold right now too. You can see it's oversold, and it looks like this is its new trading range. It's not growing. It's growing maybe 3% or 5% a year. So there's no reason for it to continue in an uptrend when if there's a stock market sell-off, it definitely will go down to like different levels of support we've had in the past, like right there or right here. So let's hope it holds right here for my sake. Tesla. This is actually a stock in the downtrend. It's oversold and at the bottom of its channel. One thing that an analyst said this week about Tesla is it could be in a situation where it might be losing money in the next year. And if they have a loss for a quarter, that would crush the stock down to like its PEG ratio of 1. Because they're actually they're reducing the price of their cars, and that's reducing the amount of money they make, and then they might even have a loss to get their market share, keep their market share. So you can see in Tesla, they have support way back here. So if they drop, that's probably going to be level support, and then if that fails, it'll go down to here after that. This is a example of a stock that was in an uptrend, and then it broke out into a new uptrend. It looks like NVIDIA is going to be, next stop is down here. So it's like 5 or 10% below where we're at now. But if it breaks through here, then maybe it'll join Apple in being a sideways performer. I don't know, but this is out of the ordinary. This could be like momentum that carried it out of there. It might have to go back into this little trading range here. The big news for stocks was this week there was a speech by Jerome Powell about interest rates, and he basically said they're pretty close to a point where they can start reducing interest rates, and that's good for stocks. That's all I got from that news. But the job report today was good, and that's bad for stocks because that keeps interest rates up. All right, so there's a little story here about traders ditching the Magnificent Seven for pharmaceutical stocks. So that could be part of our rotation into healthcare that I was talking about this year. So what I thought would be interesting, you see Bank of America says that Eli Lilly should, they're growing at 30% on their obesity drug. So I thought it would be an interesting time to check in with Eli Lilly to see if their growth rate. So from last year to this year, they were growing 200%. And now they're going back down to like 30% growth. And so they're 2 times overvalued now. So it's not, I don't know. If you want to buy it, hold it for a long time. If you want to buy it now, probably in 2.5 years, it'll be fairly valued. But this is the kind of stock you can buy whenever the stock market sells off. And Jim Cramer loves this stock. Today they had a bad report on the FDA approving their Alzheimer's drug. They said they're taking more time to figure if they want to approve it or not. So that's good and bad. It's good that probably in a month or so they'll approve it or not approve it. It's bad if they don't approve it. So let's see. Their PE is around 60. And the current PE is 134, but their forward PE is 62. So I always use forward PE. So their numbers here for return on equity and profit margin is pretty good, and they don't have much debt to be concerned about. So it looks like they're 2 times overvalued now. So I don't know. It's one that has a lot of momentum right now, but it could easily go down. If they have an Alzheimer's drug setback, that'll make it go down a lot, like 30 or 40%. Let's see. Okay, this stock right here we're looking at is Novo Nordisk. It's grown around 14% consistently over time. They have a PE of 40. They're Eli Lilly's competitor for weight loss drugs. So they're 3 times overvalued now. Their statistics are really, their PEG ratio is 4.8. So that's 5 times overvalued according to Yahoo Finance. They think they're only growing at 10 with a 4 PE of 840. So this is a very pricey stock. They're getting a lot of benefits from the weight loss drug growth, but you're paying a lot for it. So it's 3 times overvalued. Let's see. Okay, I thought it'd be interesting to go over NVIDIA because it was in the news recently. There are companies that are raising their estimates for NVIDIA. And I don't know, this seems like how they were raising estimates for .com stocks in 2000. When I did the calculations, they're growing 50% this year, 20, 10, and 23. So it's not that consistent or predictable. So if they continue to grow at 50%, they're on sale now. But it looks like next year's growth is 20, then next year after that is 10. So we don't know. We don't know. This that's a really big amount to go up in a short amount of time on not a whole lot of news. So right now they're according to Yahoo Finance, they're 40% overvalued, 1.4 PEG ratio. So I don't know, it's pretty pricey right now. It's not like obvious right now what their earnings are going to be in the future. This keeps changing and it's unreliable. So in their business model, people over order. We don't know if people over ordered this month or not, or there's just an unknown there. All right, so this is a really good video I watched. This guy named Bill Nygren, he's a value investor, and he's pretty smart. He talked about some of his holdings that he has in his Oakmark fund. He has Google as his top holding, and he talked about how Google, there's a fear right now, and all it is basically a fear that maybe AI could replace Google. But he basically says in his research, they've kept their market share, and they're selling. One thing that he did that most people don't do is he calculated their earnings, the PE, from their exiling their cash. So if a company has a lot of cash, like Google, if you take out the cash and then do your calculations, you have a lower PE than what's advertised. So right now, Google is like on sale compared, if you want to look at it that way. But he had a couple other stocks in his top 10 holdings that I thought would be interesting to look at. We looked at the Capital One last week. That's the example of a credit card company turning into a credit card network. They bought Discover Card. So that's an example. He likes to buy stocks at a PE ratio like around 10, where you have it doesn't have a lot of downside. And a lot of these stocks in his top 10 are low PE stocks. So I thought it'd be interesting to go through some of these and see if there are any that are interesting to buy. We already went over Capital One last week, so I'm going to go over the other ones. I thought it'd be interesting to look at Google again. This is one of the most consistent stocks that I follow. They've grown at 14% like every year for the last 10 years or more. So I think it might be because they're manipulating their ad purchase rates based on monopolistic tendencies. I'm not sure, just to allow them to grow more. But whatever they're doing, they have a consistent growth rate, which is very hard to come by. So if they're growing at 14% and the forward PE is 13, backing out the cash, their PEG ratio is 0.86. So I think they're undervalued. This is an example of what I call a compounder. A compounder is a stock that you buy it and you just let it grow over time. And so far, this is growing consistently around 14%. If we have some news, that's why we follow it every day. If we have news that they're going to lose some of their monopolistic powers or some of their ways they're achieving their sale or their growth, then we have to reconsider it and say, well, it's not going to grow anymore. We have to look for something else. Okay, so let's look at the tailwinds for Google. They have a TikTok ban that's ready to pass through the House, maybe the Senate. Election ad cycle this year, Trump and Biden and all the other people getting elected, and driverless cars. So I don't think they made a whole lot of money from the driverless cars, but they're probably the most reliable of the companies doing that. So it's like a bet, they call it. Okay, Google statistics. You can see their forward PE is around 19, 13 if you back out the cash, and their PEG ratio is 1.4. So profit margin is excellent at 24. That's double what we want, and the return on equity is double what we want. So that's really good too. That's good to check in with this every now and then. And you can see they have $80 billion in cash, which is a lot. The other one I looked at was ICE. This is Intercontinental Exchange, and they own the New York Stock Exchange. So they're an exchange as the primary business. And part of their moat is they have high visibility for IPOs. So whenever a company IPOs, they want prestige, they want to be associated with the biggest companies in the world, and they want free advertising on all the major channels because all the major channels are at the New York Stock Exchange covering the IPO. And a lot of times that gooses the stock price of the IPO up, getting all that coverage. So that's probably one of their biggest advantages. And right now the forward PE is 24, and they're growing at 11%. So they have a 2.2 PEG ratio. They don't have a whole lot of moat around what they do because NASDAQ is a competitor. You know, you have exchanges, a couple of exchanges open in the last couple of years. So I think their moat, if you have a moat and you have, I guess one thing they do have that most other companies don't have, they have voting privileges. Whenever New York Stock Exchange bought like Arca Exchange and Archipelago, they developed a sense of where they can have voting rights on rules for the stock market. So they have a little bit of a moat there. They can actually make rules and decide on rules for these stock markets that other companies don't. That was a good little exercise. But right now they're 2.2 times overvalued. So let's wait for that to go on sale. You can see that Yahoo Finance thinks they're growing around 12%. I said they're, 11%. So if their PE is 24, their PE is 24 and they're growing at 12%, that should be a 2. But I think Yahoo thinks they're growing around 20%. But their profit margin is good and their return on equity is good, and they don't have a lot of debt compared to their market cap. So It's just overpriced right now. Comcast. This is probably the best one of all of his picks that I like. This is their theme for their company is there's a lot of maintenance costs in maintaining all of the lines for internet communication, and they're a media company too. So they sell they stream and they sell cable services. So they have money coming in every month. That's a good residual income. So, and then they have to pay some of that money out to upgrade their hardware and their networks. So right now their forward PE is 11. This is probably why Bill likes it. It's a very low PE, and it's growing at 10. So their PEG ratio is 1.1. They're like almost fairly valued. So when the stock market sells off, we'll know that this is fair valued. And if it goes lower, then it'll be on sale. But we have to keep track of that now, just so. The great thing about this company is they have customers that are not going to switch. Once you have an internet company, it's really hard for people to go to another one. I looked at their numbers for Comcast, and all their numbers look good. Their profit margin is 12. That's low end of what we're looking for. Return on equity is 18. We like 12 or better. And their forward PE is around 10, and their PEG ratio is 0.68. So the other thinks they're 30% undervalued. But one thing I noticed, they have a lot of debt. They have 103 billion in debt and only 6 billion in cash. So that's around 100 billion in debt, and their total market cap is 165. So that's half of their market cap is debt, more than half. So that's probably why they're not selling for more of a premium, because right now interest rates are higher and they have to pay more to refinance. So I guess whenever the interest rates go down, this company will be a beneficiary and they'll go up. But I think what they did, a mistake they made, they bought NBC, like a TV station, and their media, NBC Universal, and I think that put them in a lot of debt. And they're still trying to get out of that. And that'll depress the valuation of the stock. That's why a PEG ratio sells for less. And that's why it's on sale in a way. But whenever you're investing in this company, you want to see this going down over time, the debt, and if they're paying it off. And maybe they're selling some things to pay for that or something like that, because that'll hurt a stock over time. All right. That was a good little exercise. I think I ran out of things to say. Does anyone have anything they wanted to say about anything, or just wondering?
The one interesting thing that's on the TikTok rumor, I would think Meta stock price would jump up. Actually,
Yeah,
go
absolutely.
down.
I think Meta will go up 5 or 10%.
Yeah, actually go down today.
It went down today? Oh, wow. Well, the whole stock market is going down today. So all the stocks we're following, let's look at all of our stocks. When the stock market goes down, Alphabet, that's already down. But a lot of stocks we're following are overbought at the top of their channels. When the stock market goes down, even Meta, let's look at Meta.
Meta go down.
Meta, okay. You can see they started breaking out of this channel, which was an indication, wow, they might be breaking out. But
The TikTok thing only started 2 days ago, right? So 1 or 2 days ago. So
yeah, but
that's the months of uptrend.
Yeah, but that's not. Mm-hmm. They've tried to do that before though, and it failed. Like, this is just in the House, so they have to convince Republicans, which are business oriented, that it's gonna be hard to get it passed, because there's free speech also. I mean, you can't restrict free speech according to the Constitution, so it's going to be really hard. But if they do it, it'll be a catalyst. But right now, yep, if the stock market goes down, Meta is just going to go down with it regardless of that, because that's just a potential tailwind. I mean, Just like Eli Lilly has a Alzheimer's drug, that's a potential catalyst, but it's not sure thing. So does that answer that question?
Well, yes and no. I think Google and Apple are both going up today, so not all tech stock are go down.
I think that Google, most of these stocks, look, almost every one of them is overbought. All the AI companies, but Google was one that was super oversold. Look at that, it was oversold, and it was at the bottom of this channel. So while other stock has been going up, so this one might go up while everyone else goes down, because people are chasing kind of one that was out of favor for the last month or so. So a lot of the drug stocks weren't doing good whenever all the tech stocks were going up. So it's just like flipping today. I think I'm running out of time. All right. Well, thanks for attending, everyone. I hope you have a good weekend. If you have any questions or anything during the week, let me know, and I'll cover it on the next session.
Thank you, Greg.
Thanks.
All right. See you next time.